Welcome to Module 1, Introduction to Supply Chain Finance. Let's begin by understanding the broader context of supply chains, specifically the difference between the physical and financial supply chain. The physical supply chain refers to the actual movement of goods from raw materials through manufacturing to final delivery to the customer. It includes all the logistics, warehousing, and transportation activities that ensure products get where they need to be, when they need to be there. The financial supply chain, on the other hand, is the flow of funds and related financial processes that support these physical movements. This includes payments, credit, invoicing, and financing arrangements. While the physical supply chain ensures goods are delivered, the financial supply chain ensures that payments are made efficiently and working capital is optimized for all parties involved. Historically, these two flows have often been managed separately, but integrating them is now recognized as key to unlocking working capital, reducing costs, and increasing overall supply chain resilience. Supply chain finance, SCF, bridges these two worlds. It is a set of financial solutions enabled by both legal structures and technology that allows buyers and suppliers to optimize working capital and cash flow. Crucially, SCF relies on the irrevocable payment undertaking, IPU, from the buyer, a binding commitment that gives financiers the confidence to advance funds to suppliers. We'll explore the IPU in detail later in this course. Let's compare SCF with traditional trade finance. Traditional trade finance tools, such as letters of credit and export credit insurance, are designed to mitigate risks like non-payment or political instability. These instruments are often complex, involve many parties, and may require collateral. SCF, in contrast, focuses on optimizing payment terms and working capital between buyers and suppliers. The key differentiator is the buyer's irrevocable payment undertaking, which assures financiers of payment and allows suppliers to receive early payment at a lower cost, leveraging the buyer's typically stronger credit profile. SCF is increasingly delivered via digital platforms, but it's the legal and financial structure that makes it effective. Remember, SCF is not just about digitalization. It's about integrating financial flows with physical flows, using the buyer's payment undertaking as the foundation. Why does SCF matter so much in today's global trade environment? Global supply chains are under constant pressure from disruptions, be it geopolitical events, pandemics, or logistical bottlenecks. The COVID-19 pandemic, for example, exposed vulnerabilities in both the physical and financial supply chains. Many companies struggled to source materials on time, while others faced severe cash flow crunches as payments were delayed or demand fluctuated. SCF has proven to be a vital tool for resilience. For example, during the pandemic, large buyers with robust SCF programs were able to support their suppliers with faster payments, ensuring that production continued even as markets shifted. Suppliers, in turn, could access much-needed liquidity without resorting to expensive borrowing, keeping their operations running and safeguarding jobs. A real-world example. In the automotive industry, several major manufacturers used SCF to support their Tier 1 and Tier 2 suppliers during the pandemic. By advancing payments through SCF platforms, they prevented supply chain breakdowns and maintained production schedules, demonstrating how financial and physical supply chain resilience go hand in hand. This shift is also reflected in supply chain strategy. Companies are moving from a just-in-time model, which minimizes inventory and relies on perfect timing, to a just-in-case approach, which emphasizes resilience, buffer stocks, and flexible financing. SCF supports this transition by freeing up working capital and enabling companies to invest in inventory and risk mitigation strategies. Let's look at the main players in the SCF ecosystem. Buyers. Usually large corporations with strong credit ratings. Their financial strength is central to SCF as their irrevocable payment undertaking underpins the entire program and allows suppliers to benefit from lower-cost financing. Suppliers, businesses that provide goods or services to the buyer, they benefit from early payment and improved liquidity. Financial institutions, Fintechs, provide the funding and manage digital platforms, facilitating seamless transactions. Logistics providers support the physical movement of goods and can share valuable data to enhance integration. Technology partners enable the digital infrastructure that links physical and financial flows. Regulators and government agencies set the legal and compliance framework for SCF programs. Collaboration and information sharing among these stakeholders are crucial for maximizing the benefits of SCF and ensuring both physical and financial supply chain resilience. Now, let's highlight the key benefits of SCF for both buyers and suppliers. For buyers, SCF enables extended payment terms, optimizes working capital, and strengthens supplier relationships. By supporting suppliers financially, buyers also reduce the risk of supply chain disruptions and improve the reliability of their operations. For suppliers, SCF provides early access to cash, often at a lower cost than traditional financing thanks to the buyer's strong credit. This improves liquidity, allows for better cash flow management, and enables investment in growth and resilience. In summary, SCF is a win-win solution that integrates the physical and financial supply chains, unlocking working capital, reducing risk, and enhancing resilience for all parties involved. In the next module, we'll explore the core techniques and instruments used in supply chain finance and take a closer look at how the irrevocable payment undertaking works in practice.